Inflation is a financial force to be reckoned with. It's a relentless, silent eroder of purchasing power that can have a profound impact on our savings and investments. To truly understand the implications of inflation, we need to delve into its mechanics, causes, and consequences. Inflation, simply put, is the increase in the prices of goods and services over time. It's like an ever-growing monster lurking in the shadows, waiting to pounce on the value of your money. While a moderate level of inflation is generally considered healthy for an economy, as it encourages spending and investment, too much of it can wreak havoc on personal finances. One of the most immediate and tangible effects of inflation is its impact on the value of money. As prices rise, the purchasing power of your currency decreases. This means that the money you have saved and invested may not be worth as much in the future as it is today. In essence, inflation is like a hidden tax on your wealth. The impact of inflation on savings and investments can be multifaceted. Let's first examine how it affects savings. Savings typically stored in traditional savings accounts or other low-risk, interest-bearing investments can quickly lose value in the face of inflation. When the inflation rate outpaces the interest rate you earn on your savings, your money effectively shrinks in real terms. In other words, while you may see the same number of dollars in your account, those dollars buy less than they used to. This erosion of purchasing power is particularly concerning for retirees or those on a fixed income. Their savings, meant to provide financial security in their later years, can be significantly diminished by the effects of inflation. Imagine a retiree who has diligently saved $1,000 for their retirement. If inflation is running at 3% per year, that money will lose nearly a third of its purchasing power in just 10 years. But the impact of inflation doesn't stop at savings accounts. It also permeates the world of investments. Investments come in many forms, from stocks and bonds to real estate and commodities. How inflation affects your investments depends on the type of assets you hold and the broader economic environment. Stocks, for example, can be both a blessing and a curse in an inflationary environment. On one hand, companies may see increased revenues and profits as they raise prices to keep up with inflation. This can translate into higher stock prices and potentially robust returns for investors. On the other hand, rising inflation can also lead to higher interest rates, which can reduce the present value of future cash flows, causing stock prices to fall. Additionally, the uncertainty associated with inflation can create market volatility, making it more difficult for investors to navigate. Bonds, typically considered a safer investment, may not fare as well in an inflationary environment. When you hold a bond, you are essentially lending money to an entity, such as a government or corporation, in exchange for periodic interest payments and the return of your principal when the bond matures. However, if inflation is high, the purchasing power of the interest payments and the principal can be significantly diminished. This makes bonds less attractive to investors and can lead to lower bond prices. Real estate, often seen as a hedge against inflation, tends to perform well when prices are rising. The value of real estate assets can increase as the cost of materials, labor, and land goes up. However, it's important to note that not all real estate investments are created equal. The type of real estate and its location play a significant role in how it is affected by inflation. Residential properties, for example, may not provide as strong a hedge against inflation as commercial real estate or investment properties. Commodities such as gold, oil, and agricultural products are also often considered a hedge against inflation. When prices are rising, the value of these tangible assets tends to increase as well. Investors flock to commodities as a store of value when they are concerned about the purchasing power of their money eroding due to inflation. Inflation's impact on savings and investments is not limited to these traditional assets. In recent years, new financial products and investment vehicles have emerged to address the challenges posed by inflation. These include Treasury Inflation Protected Securities, TIPS, which are government bonds designed to provide investors with protection against rising prices. They adjust in value with inflation, ensuring that investors receive a real return. Inflation also has a significant impact on the decisions made by central banks and policymakers. They carefully monitor inflation rates and may use various tools, such as adjusting interest rates or implementing monetary policies, to control it. High inflation can lead to economic instability, erode consumer confidence, and affect the overall well-being of a nation. As a result, central banks strive to maintain a balance between price stability and economic growth. The causes of inflation are numerous and complex, often involving a combination of factors. Demand pull inflation occurs when the demand for goods and services exceeds their supply, leading to rising prices. This can happen when an economy is growing rapidly and consumers and businesses are spending more. Cost push inflation, on the other hand, occurs when the cost of production rises, causing producers to pass those costs on to consumers in the form of higher prices. Monetary policy, fiscal policy, and external factors can all contribute to inflation. Central banks, through their control of interest rates and money supply, play a crucial role in influencing inflation. When central banks lower interest rates and inject money into the economy, it can stimulate demand, potentially leading to higher prices. Government spending and taxation policies can also impact inflation, as excessive government spending can drive demand and push up prices. External factors, such as changes in oil prices or exchange rates, can also influence inflation. A sudden increase in oil prices, for example, can lead to higher transportation costs, which may be passed on to consumers in the form of higher prices for goods and services. Exchange rate fluctuations can affect the cost of imported goods, which can, in turn, impact domestic prices. Now let's explore the consequences of inflation on savings and investments in more depth. As we've seen, the erosion of purchasing power is the most immediate consequence of inflation. This has a direct impact on the standard of living for individuals and families. When the value of money diminishes, it takes more dollars to buy the same goods and services. This means that you need to spend more of your hard-earned money just to maintain your current lifestyle. Retirees are particularly vulnerable to the effects of inflation. After years of saving and investing for retirement, they rely on their savings to cover living expenses. If their savings don't keep pace with inflation, they may find themselves with reduced purchasing power and a lower quality of life in their retirement years. Inflation also has a profound effect on fixed income investments, such as bonds. When you invest in a bond, you are essentially lending money to an issuer in exchange for periodic interest payments and the return of your principal when the bond matures. However, the purchasing power of those interest payments and the principal can be eroded by inflation. This means that the real return on your bond investment may be much lower than you initially anticipated. Furthermore, the impact of inflation on interest rates can make bonds less appealing to investors. As central banks respond to rising inflation by raising interest rates, the value of existing bonds with lower interest rates decreases. Investors may be reluctant to buy new bonds with fixed, lower interest rates when they can get higher returns in other investments. This can lead to lower bond prices and potential losses for bondholders. In the world of equities, or stocks, the impact of inflation is more nuanced. Companies may experience increased revenues and profits during periods of inflation as they raise prices to keep up with rising costs. This can translate into higher stock prices and potentially robust returns for investors. However, there are also challenges associated with stocks in an inflationary environment. Rising inflation can lead to higher interest rates, which can reduce the present value of future cash flows, causing stock prices to fall. Additionally, the uncertainty associated with inflation can create market volatility, making it more difficult for investors to navigate. The impact of inflation on real estate investments depends on the type of real estate and its location. Residential properties may not provide as strong a hedge against inflation as commercial real estate or investment properties. Rising inflation can lead to higher construction and maintenance costs, which can affect the profitability of real estate investments. On the other hand, the value of real estate assets may increase as the cost of materials, labor, and land goes up, potentially providing a hedge against inflation. Commodities such as gold, oil, and agricultural products are often considered a hedge against inflation. When prices are rising, the value of these tangible assets tends to increase as well. Investors flock to commodities as a store of value when they are concerned about the purchasing power of their money eroding due to inflation. To mitigate the impact of inflation on savings and investments, there are several strategies that individuals can consider. 1. Diversification. Diversifying your investment portfolio can help spread risk and potentially provide some protection against the effects of inflation. By holding a mix of assets, such as stocks, bonds, real estate, and commodities, you can reduce your exposure to any single asset class. This can help you capture the potential benefits of different investments while mitigating the risks associated with inflation. 2. TIPS, Treasury Inflation-Protected Securities. TIPS are government bonds designed to provide investors with protection against rising prices. They adjust in value with inflation, ensuring that investors receive a real return. While TIPS can provide a hedge against inflation, they may have lower yields compared to other fixed-income investments. 3. High-quality dividend stocks. Investing in stocks of companies with a history of paying dividends can provide a source of income that may keep pace with or outpace inflation. These companies tend to be more stable and resilient in challenging economic environments. 4. Real assets. Investing in real assets, such as real estate and commodities, can offer a hedge against inflation. Real estate in particular may benefit from rising property values and rental income. 5. Inflation-linked annuities. Annuities are financial products that provide a guaranteed income stream in retirement. Some annuities are inflation-linked, meaning that the income they provide increases with inflation. These can be a valuable tool for retirees seeking to protect their purchasing power. 6. Precious metals. Gold and other precious metals are often considered a hedge against inflation. They have a long history of retaining their value during times of economic uncertainty and rising prices. 7. Regular portfolio. Rebalancing. Regularly rebalancing your investment portfolio ensures that it remains aligned with your financial goals and risk tolerance. It can also help you make adjustments to your asset allocation as economic conditions change. 8. Consult with a financial advisor. Seeking advice from a financial advisor can help you develop a personalized investment strategy that takes into account your specific financial situation and goals. An experienced advisor can help you navigate the complex landscape of inflation and make informed investment decisions. In conclusion, inflation is a powerful force that can have a significant impact on savings and investments. Its insidious erosion of purchasing power can diminish the value of money held in savings accounts and the returns on fixed-income investments like bonds. It can also introduce uncertainty and volatility into the stock market, making investment decisions more challenging. While inflation is a natural part of the economic cycle, individuals can take steps to protect their savings and investments from its effects. Diversification, TIPS, high-quality dividend stocks, real assets, inflation-linked annuities, precious metals, and regular portfolio rebalancing are all strategies that can help mitigate the impact of inflation. It's crucial for individuals to stay informed about economic conditions and to seek advice from financial professionals to make informed investment decisions that align with their financial goals and risk tolerance. By taking proactive steps and considering the impact of inflation on their financial plans, individuals can better position themselves to preserve and grow their wealth in an ever-changing economic landscape.